I heard from this guy named Alex that we should prioritize retirement early. Yeah, sinspiration, right? I'm going to contribute to a traditional 401k so I don't have to pay taxes now. My employer doesn't offer a 401k, so I have to open my own IRA. I want to have tax-free money when I retire, so I'm going with a Roth account. But would I end up with more money in a tax-free account? I'll have more money saved up, and the earnings will grow to even larger amounts. I also should be in a lower tax bracket when I retire. Good point. There's no way to know how our investments will do and what the tax brackets will look like in 40 years. Let's see what Sinspiration has got to say. Hello there. I'm Alex. Welcome to Sinspiration, where I inspire you to develop a growth mindset. By now, you should be convinced that you should prioritize retirement now. The earlier, the better. Don't make excuses. You'll thank me later. If you're not, check out my previous video. Today, I will dive into the most common retirement accounts: 401ks, IRAs, and traditional versus Roth accounts. First, a history lesson about retirement in the US. Until the 1980s, most Americans received pensions during retirement. Employers would save money for their employees. An employee's retirement benefits are based on the years of service and final salary. The employer has to estimate how much money to give their employees and tie it to the company's projected earnings. One major problem was that executives would get huge benefits and a much larger share of the company's profit sharing. That's when the Revenue Act of 1978 was passed to give employees the option to defer compensation in a tax-advantaged way. Now, the burden, cost, and risk have shifted from the employer to the employee. Ted Benna is the father of the 401k, and he advocated for companies to adopt the plans in accordance with the Revenue Act of 1978. Employers would automatically enroll workers into 401k plans unless an employee decides not to participate. Shockingly, 68% of private sector American workers had access in 2021, but only half actually took advantage of it. You're watching this because you want to be that half that takes advantage of retirement accounts, know what your options are, and understand how they work. Note that the numbers that I'll be using will be based on the 2023 tax year because we have passed the 2022 tax deadline in April. The 401k, the most common retirement account. This is a company-sponsored retirement plan where you can contribute your part of your income and your employer can match part or all of your contributions. You can then invest this money, usually in mutual funds. There are two types, traditional and Roth. For traditional accounts, you are contributing pre-tax money, meaning you are deferring paying your taxes until you withdraw them during retirement. Any investment earnings will also be subject to income taxes when you withdraw. For Roth 401k, you pay your taxes up front, and so when you withdraw your money, they are tax-free. Any investment earnings are also tax-free when you withdraw. The annual contribution limit in 2023 for people younger than age 50 is $22,500. If you are age 50 and over, you can contribute an additional $7,500 called a catch-up contribution, so up to $30,000 per year. Employers may also match your contributions. For example, 50 cents for every dollar you contribute, up to a certain percentage of your salary or compensation. If it is 10%, that means if you contribute 10% of your annual gross income into your 401k, your employer will match you with 5%. This way, 15% of your annual gross income will be deposited into your 401k. In 2023, the employee-employer contributions cannot exceed $66,000 per worker under the age of 50. If you are 50 and above, you can include the catch-up contribution, so that would be $73,500. For withdrawals, you'll need to be at least 59 and a half years old or meet hardship criteria defined by the IRS in order to avoid a 10% early withdrawal penalty. You'll also have to pay taxes you owe as soon as you withdraw. For a traditional 401k, your contributions and earnings will be subject to taxes when you withdraw. For a Roth 401k, your contributions can be withdrawn tax-free, but your earnings will be subject to taxes. 10% plus taxes, this is why early withdrawal is highly discouraged. So wait until you're 59 and a half. Traditional 401ks are subject to required minimum distributions, RMDs, at the age of 73 in 2023. In 2033, that age goes up to 75. Both are thanks to the Secure 2.0 Act. The RMD amount is determined by taking the December 31st balance of each account and dividing by a life expectancy factor. Roth 401ks are subject to RMDs in 2023, but will no longer be required in 2024, also thanks to the Secure 2.0 Act. If you don't take the RMD, the amount not withdrawn is subject to a 50% excise tax. Luckily, the Secure 2.0 Act lowers the excise tax to 25%. It can further be lowered to 10% if you correct the RMDs within 2 years. The Secure 2.0 Act also allows you to withdraw up to $1,000 per year for emergency personal and family expenses without paying the 10% early withdrawal penalty, starting in 2024. Another method of tapping into your 401k is to take out a loan from it. You can take out a loan of up to half your 401k balance or $50,000, whichever is less, but you have to repay it with interest within 5 years. The good news is the interest goes into your 401k, so you're effectively paying yourself. If you default on your payments though, your loan will convert to a withdrawal, and you know what those penalties and taxes are. If you change jobs, you will be asked to repay the remaining loan amount very soon. Many of you may not be familiar with the 403b and 457b accounts. These are equivalent to the 401k, except the 403b is offered to private nonprofits and government workers, including public school employees, and the 457b is offered to state and local government employees. The 403b is the same as the 401k in terms of standard contribution limits, having both traditional and Roth types, and withdrawals. One main difference is that after December 31st, 2024, people ages 60 to 63 will have higher catch-up limits. It will be the higher of $10,000 or 150% of the standard catch-up limit for that tax year. So in 2023, that would be more than the standard $7,500 catch-up limit. There is also a lifetime catch-up provision or 15-year rule, where employees who have at least 15 years of tenure may contribute an additional $3,000 a year. However, the lifetime employer-by-employer limit is $15,000. 403bs also vest funds faster than 401ks, sometimes even immediately. However, the investment options in a 403b are much more limited. The 457b is another option for state and local government employees. You can actually contribute up to 100% of your salary, but you are still subject to the annual contribution limit of $22,500 in 2023. Similar to the 403b, the Secure 2.0 Act allows people ages 60 to 63 after December 31st, 2024 to make 457b catch-up limits the greater of $10,000 or 150% of the catch-up limit for the tax year. For 2023, the standard amount is $7,500, which is the same as 401k and 403b. Additionally, there is a double limit catch-up provision. If you are within 3 years of normal retirement age, you can actually contribute double the contribution limit. That's $45,000 instead of $22,500 in 2023. One big difference with a 457b is that there is no 10% early withdrawal penalty if you resign or retire early. Reminder that you are still subject to income taxes due. But if you switch employers and you decide to roll over your 457b into a 401k account, you will be subject to the 401k rules, and that means you will have to pay the 10% early withdrawal penalty if you do so. so that is not recommended. It's not an issue if you're 59 and a half or older, but it's best to keep your funds in the 457B. The drawback of the 457B is the limited investment options, and employer matches are rare, contribute to your annual contribution limit, and are subject to a vesting schedule. So, the sum of your contributions and your employer contributions cannot exceed $22,500 in 2023. And this applies to the catch-up limits as well. And if you leave your job, you forfeit unvested funds. Individual retirement accounts, also known as IRAs. The name is literally what it means. It's your own retirement account. The rules with traditional and Roth accounts are the same in terms of taxes and withdrawals, but there are a few differences compared to 401k, 403b, and 457b. Anyone with earned income for the year can open and contribute to an IRA, even if you have a 401k, 403b, or 457b. The contribution limit in 2023 is $6,500. If you are the age of 50 or over, you can make a catch-up contribution of $1,000, totaling $7,500 for the year. For traditional IRAs, your contributions may be tax deductible. They are fully tax deductible if you do not have a retirement plan at work. If you do and are filing as single, you can get a full deduction if your 2023 Modified Adjusted Gross Income, MAGI, is $73,000 or less. If your MAGI is between $73,000 and $83,000, you will only get a partial deduction, with no deduction if your MAGI is $83,000 or more. Take a look at the table for other tax filing statuses. Roth IRA contributions are not tax deductible, so you pay your taxes upfront, but your distributions and investment earnings are tax-free. You also don't have a required minimum distribution as long as you're alive. The catch is there are income limitations to how much you can contribute. For single filers in 2023, you can contribute up to the $6,500 or $7,500 limit with catch-up if your MAGI is less than $138,000. The phase-out range is from $138,000 to $153,000. Take a look at the table for other tax filing statuses. If your income is too high, sorry, you can't contribute to a Roth IRA, but there is something called a mega backdoor Roth. That will be covered in another video. One benefit is that IRAs are FDIC insured, whereas most 401ks are not. You can have peace of mind knowing that up to $250,000 per account is insured, unless you invest that money. Which brings me to my most favorite part about IRAs. You can invest your money into stocks, bonds, mutual funds, exchange traded funds, treasury bills, crypto, anything. You have full freedom in where you want to invest your money rather than the select mutual funds in 401ks. If you want your money to be FDIC insured, you can put your money into money market funds or certificate of deposits. Also, there are little to no maintenance fees for IRAs, whereas some employers charge you maintenance fees for 401ks. So you may want to double check on that. As you can see, there are different retirement plans to choose from. Your situation may be different from your friends or family members, so it's up to you to decide how you want to save for your retirement. 401k, 403b, and 457b depend on what your employer offers. IRAs can supplement these accounts or be your sole retirement account if your employer does not offer a retirement plan. But how much should you contribute? Should you go with a traditional or a Roth account? And what should you invest your retirement funds in? I'll answer these questions in my next video. In the meantime, like this video and comment below with questions you have about these retirement accounts. Don't forget to subscribe to my channel to get updates on new videos, and check out my page for more content on how to grow your mindset. You've been inspired today. Take advantage of your employer retirement plans and/or open your own IRA and start contributing today.